Hey everyone, thanks for watching. We are on our second of our weekly series with Greg Dickerson. And as you will see in a moment, he has joined us from a Panera Bread. So shout out Panera Bread. Let's welcome Greg to the show. How you doing, Greg?
Good. I'm here, Michael. Yep, there it is.
There it
Live
is.
and in person in Panera. Yeah.
There you go. Well, thanks for doing this. I know you got to juggle schedules to make these weekly meetings work. Both myself and the viewers appreciate you doing this. So we kind of talked, and we're going to talk about syndications today, kind of
Yep.
the do's and don'ts, what you see, because there are lots of rules, and it's not as easy, or it's not as easy as people make it look in social media. So why don't you kind of open it up with
Yeah, absolutely. And yeah, these are a lot of fun. So you never know where I'm going to be.
yeah.
I got a meeting here in a little bit. So today's a Panera. Last week I was on site at a project. Tomorrow I'm headed down to the Outer Banks of North Carolina, which is a resort area off the coast of North Carolina, and I do projects there. So, I just wherever I'm at, man, I bust out the laptop and here we go.
There we go.
But
Exactly.
yeah. So syndication, is interesting. So a lot of people, when you say syndication, they think of, big real estate deals, right?
Mm-hmm.
And, they think of, mainly, raising capital and bringing in investors. Well, syndication is a lot of things. What it is really is pooling of resources from a number of people to do a bigger deal or transaction than you're capable of doing on your own. So it could be real estate, it could be a business, it could be, a movie, it could be one house, it could be anything.
Right.
So you're just pooling resources, which can be money, intellectual capital, time, energy, talent, whatever it is, you're pooling those resources to do a bigger venture than you can do on your own. So that's what a syndication is in the business world, in the real estate world. In the media, you're syndicating out to other broadcast channels. So it's a
Yeah.
little different there.
Okay.
But what a lot of people don't realize is you've got the federal government, the Security and Exchange Commission that regulates the securities laws. So whenever you take an investment from somebody for, and they're totally passive, for a financial gain and mutual benefit of all the parties, that's a security. So I encourage your listeners to look up the definition of a security, because a lot of people think that, hey, I only have one investor in one deal, or I only have two investors, we're just going to do a joint venture.
Mm-hmm.
Well, what you're actually selling is a security if you're offering a return, if you're offering benefit in exchange for, their money. So you want to make sure that you understand that the federal government has their rules and laws, and then every state has their own securities commission that regulates securities within the state. So every state's different, and they have their own rules and laws that may or may not be the same as the federal government. And, as you can be in violation or both, in different ways. So I just encourage everybody to to research that and understand what is a security and what is not, and when they need to be in compliance and when, they don't have to worry about it.
So you mean you just can't go on Facebook and say, I found a 30-minute or 30-unit deal in Texas and I just need $1 million? I can't just do that?
Well, you could probably say something like that, but
Right.
if you say I'm looking for people to invest with me, then
Right.
that's where you get it. So whenever you get into general solicitation,
Right.
without the proper filing, you can't do that. You are in violation. Now, somebody has to report you. They have to find out, and usually a lot of the violations that are happening now of securities laws don't typically come to light until the deal goes south,
Yes.
things blow up, and people start filing lawsuits. And that's when, the SEC gets involved and the state commission gets involved. And, generally, unless there's fraud or something just flat out illegal, you're not going to go to jail. You're going to get fined. You're going to get barred from ever being able to raise money again, and you're going to have to pay everybody back. So that's your recourse that you'd be facing. But the best thing to do is just understand the rules and laws. There are certain filings. The 506C under Regulation D does allow general solicitation, and so does a Reg A crowdfunding filing. So those do allow general solicitation, where you can go on to the internet and say, hey, for accredited investors under a 506C, you can invest with us. Here's an opportunity under a Reg A. You can take, non-sophisticated or non-accredited investors in a Reg A filing. So there's different filings, different levels, and different requirements of all of them. So it's a good idea to be aware of those so that you can make sure you're in compliance. And if you want to solicit and you want to do crowdfunding and you want to raise money, then just do it the right way. Do the filing. Once you get your deal under contract, contact your attorney, set up all the paperwork. They'll do your filing. You'll have a operating company LLC. You have a property level LLC that you and your investors will be the general partner and limited partners in. They'll handle all the filing for you. It does cost money, but you know what? It's the way to do it. And then it opens up the floodgates to capital so you can do bigger deals.
There you go. One of the things that I've known for some time is 506C and Reg D. Why don't we break down Reg A a little bit? Because I think just based on your description, that is the wrinkle that Grant Cardone is using with this non-accredited investors. You know, he now takes $10,000 minimums from folks. And I wasn't sure how he was doing that, but I'm guessing it's Reg A crowdfunding. Is that?
Yeah. So So Regulation A is the crowdfunding regulation, and there's a couple of different types of Reg A filings that you can do to raise. Like he does the $50 million fund, so he's able to raise up to $50 million bucks. And you know his minimum might be 10,000, but they can go much lower than that. So it's really up to you what your minimum investment's going to be. I mean, you can go all the way down to $100 bucks, you know, if you want to. So, yeah, that's what the Regulation A. So Regulation D, or Section D, you know, of the code is where these rules and laws are. And then under that Section D is the Regulation, you know, B, C, and A, B, and C filings, and the different types of filings that you can do in there. Excuse me, I got a dry throat today.
No worries.
Yeah. So the Reg A is cool. Now, the Reg A does require a lot of financial disclosure. They're going to audit, you know, the company. They're going to audit the financials, you know, things like that. So it's a longer process. It's a little bit more expensive.
I'm sure.
Well, quite a bit more expensive than a you know, 506B or C. But you know, it does open up opportunity for anybody to invest in your deal. So if you have a lot of people that say, hey, man, I got $1,000, I got $20,000. They're not accredited. They're not sophisticated. They just have some money they want to invest. Like my mom. I was talking to my mom the other day. She's like, you know, I got 25 grand that's, you know, sitting over here getting 1 or 2%. What should I do with it? I'm like, well, you know, there's not really a whole lot you can do with that. If I had a Reg A, you know, I would be able to, you know, take her money and put it to work and do some deals. But you know, I don't want to do that.
Yeah. That's a different kind of pressure right there. Forget the federal government, man. That's mom pressure right there.
Well, and just having like, you know, that many investors, you know, that's just not something at my point in life that I want to do.
Yeah.
You know, I never really have. Like you, I've been mostly self-funded. I do have a handful of people that I do deals with, very long-term relationships, people I've known for a long time. We understand each other. We know what we're doing, and we're all, you know, big people, big boys. And, you know, if we lose money, we lose money. If we make money, we make money. So, you know, when you start getting thousands and thousands of people together and something doesn't go right, you know, it's, you know, I just don't want to be responsible for that.
Yeah. We're going to talk about that in a minute, but I want to go real back to we've used this word a couple of times now, and we should never assume it's that accredited investor. Yes. You want to kind of define what that is, and then I'll have a follow-on question for you. You want to define it first?
Yeah, so accredited investors are, I'd have to look it up exactly, but, you know, it's a net worth over $1 million for, you know, married couples. I think it's 500K individuals. You got to have liquid assets. I think it's 100K individual, 150 individual, and then 200K collectively as a couple. I'd have to look at official.
Yeah, I think
to make sure I'm right.
Yeah, what I remember it being is you had to have $1 million net worth, excluding your primary residence, or, which always drove me crazy, or make more than 200 grand a year in your W-2. I was like, well, just having a high income doesn't make you accredited. It makes you live in the Silicon Valley. I mean, that always drove me crazy. So.
Yeah, exactly. So to be accredited investor, you must have, hang on, I just had it pulling it up here. Yeah, you must have a income exceeding 200,000 a year or 300,000 for joint.
Okay. For
the last 2 years of earning, you've got to have that liquid assets, or not liquid, but you know, a net worth exceeding $1 million individually, or joint with your spouse. So that's what the SEC requires for accredited investors in terms of their definition. And you know, those laws are changing. So they have there is something out there right now where they're loosening the requirements a little bit for accredited investors to make it a little bit easier for people to get into some deals and investments.
Yeah, and the reason I wanted to bring this up, just to kind of set the line in the sand, is because of that. They're loosening up, redefining it. But it's really because, quote unquote, the best deals, whatever you want to call that as, used to only be for quote unquote the rich, right? If we rewind a decade, it was all the rich people getting richer, just because they had access to these deals because they were accredited. I mean, I remember 10 years ago, when I first clipped that mark for the second year being called accredited, I was amazed at what my, my portfolio analysts and people would call me about. I mean, it was like a foreign
Yeah.
language the first time.
Yeah.
So there really is a difference between what you could consider as an accredited investor or not. Is that your experience as well?
Yeah. So there is that definition of the accredited investor, but just because you have that income, just because you have that net worth, doesn't mean you know what you're doing, and you understand how to evaluate an investment, right? And know whether it's good or not. I mean, you could be, a sports athlete that just came into all this money, and now they do have, in the NBA, NFL, Major League Baseball, they have training and they have advisors and things like that. But generally, people that come into money quickly, they don't know. How to evaluate an investment, how to evaluate an operator, sponsor, money manager, things like that. So you have to be very careful. And all the government can do is just say, hey, here's this general rule that if you've made this amount of money, well, you must be, of some level of intelligence and, financial understanding to be able to, know what you're getting yourself into. But it doesn't always work. So they're loosening that up because there's more people that want to invest and that can't take advantage of investment opportunities because they're not accredited. And I haven't followed the news on it lately in terms of what that loosening of the requirement is. But and then the other thing is, certifying that you're an accredited investor. So you have to have an audited statement or a statement from your accountant certifying that you're accredited, or you have to submit paperwork. So that gets a little tricky as well.
Yeah. So one more on syndication do's and don'ts. You want to, without naming anybody, let's not put anybody on blast, but you want to talk about some of the things that you've come across your desk or your email that you're like, that's just not okay. You want to give some samples for folks?
Well, mainly it's like you said, and I'm typing up right now for this new requirement for accredited investors, just to see if we can pull anything up while we're talking.
Okay.
Generally what I see more than anything else is I'll get an email out of the blue, because I'm on social media and I coach and educate and teach people. And so I get people reaching out to me all the time saying, hey, I've got this deal. I'm looking for investors. So, I mean, you can't do that. So, as a syndicator and to, in order to even send your opportunity to an investor, you have to have a prior substantive relationship, which means, the IRS defines it with the 3-touch rule. So, you have to have had 3 meaningful contacts with an investor before you can even send them an opportunity to invest or send them a deal. So I'll get emails out of the blue, just, hey, I got this great deal, you want to invest? Or I'll see something on Facebook, people talking about, I have this deal, anybody want to invest in it, or, things like that. So those are the biggest, most blatant things that you see people doing that they just don't know, or they don't care. I think a lot of them don't care, because they don't feel like they're ever going to get caught.
Yeah. Well, they're going to, again, to your earlier point, all this is well and good when the market's like this. When the market goes like this, there are going to be lawsuits and things are going to blow up. You're going to have hurt feelings. And not only will you have people getting fined and all of that, I'm still on record saying that some people are going to go to jail. But we'll see what happens in 4 or 5 years.
It may happen, I mean, those are situations of fraud and, where you've got people just flat out, doing Ponzi schemes and things like that. And they're out there all the time, and you'd be surprised who those people are. But like I said, generally, if you're just in violation and you're, not filing the proper paperwork and you're raising capital, illegally, things like that, they're just going to make you give the money back, plus the return. And, you're never going to be able to allow to, raise money again. So, that's generally what's going to happen. People going to jail, there'd have to be something really seriously, fraud, misrepresentation, malicious intent, stuff like that. I mean, they're not looking to lock people up. They're looking to keep people from, breaking the law.
Yeah, exactly. Well, let's go back to the whole self-funding, meaningful relationships. How we run our businesses is kind of similar. I have, probably let's call it 10 guys that I've known for 20 years or more, go to the weddings, probably 300 touches, right? Not only 3. And we've done some deals together. I've only ever either self-funded or paid cash and then went back and kind of refied out with, individual people, one asset, one lender. Kind of thoughts and advice on that. Where do I need to be careful? Ask any questions if you need questions.
Yeah. So the first thing you want to do, so you mentioned that you do one investor at a time, just like one rental at a time, right? And you give them a note and deed of trust.
Yep.
Okay. So that note and deed of trust is a security.
Yep.
Okay. It's a security instrument. So you just need to make sure that, you know, in the state of California, you're in compliance with whatever rules, laws there are regarding that security instrument. You probably are okay. Most states, that's okay if you've got a note and deed of trust, but in some states it's not. So, you know, and also with the federal government, some situations it's okay, some it's not. So you just want to make sure that you're in compliance and that you don't have to do anything. If you do, you know, to file an exemption with the federal government's free. So it's not a huge deal. And then your state is probably whatever it is, I don't know, $100, $200 to, you know, go ahead and file that exemption there and, you know, be on the record and be clean. So that's all I would do is I would just make sure that, you know, that one person at a time, you know, is okay. Or if you have a couple of people and that group is getting, like say, let's say you have 3 investors and they want to go in a deal with you and you're giving a note and deed of trust to those 3 investors, then maybe they need to be an entity or an entity needs to be formed that they become the members of, and they're the lender, that LLC or whatever is the lender that receives the note and deed of trust. So that kind of, you know, separates things. So that's what I would say is just be careful there.
Yeah, that's exactly what I would have to do if I was going to do multiple people or pool capital, if you will. I would have to create that. And I'm like, nope, too hard. I'm out. I'll self-fund or, you know, do individual investors for that reason.
So the upside to that is, you know, you've given a note and deed of trust. So you have a mortgage, you know, that you're paying back those private investors. The downside is you have a note and deed of trust and a mortgage that you have to guarantee and you're on the hook for.
Sure.
So the difference is between that and a syndicated deal where you're raising the capital is you give a preferred return, which only means that you only pay in the event that the deal makes the money to pay, and you don't personally guarantee it. It's an investment versus a note and deed of trust, you know, that you're guaranteeing and you have to pay back. So those are the ups and the downs of that. So if you can switch to a model to where you're offering a preferred return, and, you know, if the deal works, great. If it doesn't, well, it doesn't work. You know, you're not on the hook for anything personally because you don't know what could happen. Anything can happen. You know, and the last thing you want to be is on the hook for something personally when everybody, you know, we're all big boys, we're all investors. We know we're taking a risk to invest, and that can go well or it can not go so well. So why should you be on the hook if the market just tanks? You know, rent controls come into place and you didn't do anything. Now all of a sudden you could lose everything you have because you guaranteed a loan. So you know, you want to be really careful about loan guarantees and think always in the worst case scenario and just say, you know, it may not be something that the fires. Okay, these California fires, everybody says, oh yeah, I've got insurance. But man, if they burn down your portfolio, dude, you know, with your deductibles and all that and the loss of income, you're gonna have a hard time recovering from that. You know, but you're going to be on the hook for all of those notes that you guarantee. So I would just think about that in your business model. And if there's a way to change that with your investors moving forward, I would change that moving forward because they're big boys. They know they could lose their money. And the last thing you want is a bunch of lawsuits. And, you know, Jeff, who's your best friend for 20 years, you know, he's not going to come after you. But if he dies and something goes wrong, his family probably will. Because they're going to have an estate attorney. So, you know what I mean? So things aren't always what you think they are. And they're not always what they seem when circumstances beyond our control change and when money's involved. So those are my cautions to people in terms of structuring deals and things like that. Much easier to do a non-secured investment than it is a note or, you know, debt.
Yeah, very cool. I love that. And yeah, I will certainly look at that because I have treated it all as debt. Yes, absolutely right. I will look into that. I appreciate that advice. Why don't you talk about how you have personally raised or pooled capital and just some of your examples, just so people get a taste of how to do it right?
Yeah. So I didn't know what I didn't know when I started out. You know, I took everything I made and I reinvested. So I was self-funded. I signed on the loans with the banks. I didn't even know about non-recourse when I first started out. You know, I was just a little remodeling guy. We've talked about it. So I learned the hard way by doing. I got fleeced by one of my mentors who was my first partner in some spec houses that we did. Cost me a few $100,000, but, you know, I learned so much from that and made tons of money from it. He was supposed to be the money and the guarantor. The next thing you know, I'm signing on the notes with him. You know, I had nowhere near of a net worth like he did at the time. You know, I'm putting up all the money to start these when he was supposed to be. So it totally took advantage of me. And then here's the kicker. So we were on the notes together on these properties, these rental houses that we'd built. I wanted to sell them. He wanted to keep them. He turned around and refinanced these things, pulled the equity out, and didn't even tell me. You know, and I'm on the note. I'm like, how did you do that? I'm on the note. He signed my name. signed my name on that refinance. So unbelievable, what happened. So I learned a great lesson through that. But generally, the way I did it moving forward, or coming up, was I just used my own money. I borrowed from the banks, and kind of did it that way. And then I started getting together with some friends that were watching what I was doing. I was a builder, developer, and I built this company. I was doing a lot of different things, and they would come to me and say, "Hey, let's do this project together," like a hotel deal. So I used to buy hotels, tear them down, build big oceanfront houses. So my mortgage broker, who was doing all my loans, found an opportunity to do an oceanfront hotel. She came to me and said, "Hey, I've got this hotel. We can buy it for $4 million bucks." So she asked me about it. What's it worth? What can we do? And I said, well, the property's worth about $6 million. The market was going up. This was 2001, 2002.
Okay.
I said, we buy it for $4. We can tear it down, sell it for $6, or we can redevelop it, build oceanfront houses. And, so there was another friend of ours we were doing deals with. So the three of us got together, wrote up a partnership agreement. I put the property under contract, tore the hotel down, and facilitated the whole transaction. And all three of us put up the startup money. All three of us signed on the loan with the bank. And then we split the lots up because there were 6 oceanfront lots and 2 on across the street. So
Wow.
each person got 2 lots, and then ultimately did their own deal on the development side. So that was one of the first, I guess you could call, joint venture deals that I did. Something else that was really cool as a builder developer, building spec houses. What a lot of people don't know, there's a lot of lumber yards, lumber companies that have construction loan programs, basically hard money loans for their builders.
Oh.
So it's asset-based lending. So they take the project and the cost of the project and loan you a percentage of that, non-recourse. There's no, well, they do want you to personally guarantee it. I didn't, because I was a big builder, but
Okay.
at the time, but now most of them are requiring personal guarantees. So there's lumber companies that will loan to spec builders in a lot of markets, to build spec houses. So I started taking advantage of that and using that program, which I learned from the first guy I did deals with. So I had a little bit of that going on. I had a little bit of partnerships that I started doing with some friends, that were business acquaintances, business friends. So these were not personal relationships. Never did deals with family, never did deals with close friends. These were always just business. We were business, colleagues first,
Sure.
and then friends later. So that's kind of how all that came about. And then over the years, I started doing some deals with some very sophisticated developers. Some of these guys are worth, $400 or $500 million, and building high rises in DC and Richmond and, up in Hampton Roads area that were coming down to my market and buying property. So I started learning from them in terms of how to do land development, how to do commercial development, things like that.
Yeah.
And, so I continued to blend of both. I kept using the banks for my own deals. Now, this was pre-2009, so I did learn about non-recourse from these developers. Everything I was doing was non-recourse, all of my loans. I had a nice balance sheet, had a nice, business with cash flow and all that. So, things were good. And then 2009 happens, and everything changed. So you could no longer borrow money for development. Nobody was loaning money for development. All those construction loan programs at the lumber yards dried up because they were taking houses back left and right. The banks were not lending on spec development at scale anymore. So I had to shift my whole business model. So I was self-funding a lot, just cash, right? So I was just using my own cash to do my development deals. I had a few friends with cash, so we were doing deals together. And then there were a few banks that were loaning a little bit here and a little bit there. So we kind of inched along and crept along, after 2009 through the years. And I just reduced the size of the projects I was doing. All of my big, players that were, mentors, man, they were bleeding. One guy had a $200 million building he built and lost a bunch of tenants. And I mean, he was just bleeding. And, so it was just an ugly time. And, a couple of guys that were billionaires, two of the biggest developers in the Hampton Roads area, they went bust and lost everything they had. I mean, they were worth $1 billion each. They each had their own Gulf Stream. It was crazy.
Wow.
Brothers. And so it was really wild what was happening. But things are different now. So now you can borrow money again. Generally, unless you're very sophisticated and you have a nice balance sheet and it's a great project and you put a lot of equity in, you're not going to be able to get non-recourse other than multifamily. For commercial development, things like that. Generally, they're going to want recourse unless, again, you have a track record, you've got a good balance sheet, you've got enough equity in it. But multifamily, non-recourse all day long, the agency debt. So, that is the space to be in right now because they are confident enough. And I mean, that'll tell you something right there. If a bank's going to lend you money non-recourse, there's a lot of confidence behind that decision because that's going out to the broader markets, right?
Yep.
And these are institutions, hedge funds, investment funds, sovereign wealth funds, insurance funds, retirement funds, university endowments. Those are the people that are investing money with Freddie and Fannie to buy these mortgage-backed securities, right?
Mm-hmm.
It's what tanked us in 2009, but here we are now in multifamily. That will tell you how safe of a space that is.
Yeah.
And the bigger the deals, the better it is, the easier it is, and the more they want to lend.
Wow.
So that's why it's great that we're having this conversation today about syndication, deal structuring, how to do it, because the money is available. Debt is a commodity right now, and equity is a commodity. People are looking for yield. They're looking like my mom. She's got 25 grand. What do I do? I'm not making any money with it here. So there's people out there with, 25, 50, 100, 500,000, a million, that are looking to put into these things because they know if, these other institutions are putting their money in these assets, well, they're going to be safe as well for the long term. So It's a really good time to be out there right now. We've kind of seen it come full circle for the multifamily side. Commercial's still a little different.
Still a little different, yeah. I am curious, how does the, I think it was 6 oceanfront lots and 2 across the street, how'd that deal work out for you?
So that was an interesting deal. So it worked out really good. I don't know, I made $600,000-700,000 on it personally.
That's okay. That doesn't suck.
Yeah, over a couple of years. So I ended up building 2 oceanfront houses and selling those off. And I don't know. I think I had $1.8 million in each one of the houses, and ended up selling for like $2.4 million.
Okay.
And then I had the property across the street that I think my basis in that, this was 0102, probably $250,000. I was going to build a couple of houses on those, and right as I was getting ready to go get the permits, I got a phone call just out of the blue. These people, it was a little cottage court, so it was 2 lots, and it had 4 little cottages on it. And I got a call from these people that, wanted to buy the property, and they wanted to rent the cottages. And I thought they were nuts.
Yeah.
And I said, okay. So I sold it to them and, made whatever, 150 grand on that. So
Just
between the 2 houses and that, it was like 600 grand over a couple of years. So
there you go.
It wasn't bad.
It wasn't bad. Listen to you. It wasn't bad. That's very cool.
Well,
so
that was one of my first bigger deals. That probably was the first biggest deal that I did. Yeah.
Right.
All together, all said and done, between the value of the land, the buildings that were built, it was a $20 million project.
Yes. Yeah. I mean, that's what people can see is possible out there, right? That when you're talking about, hey, you want to buy a $4 million hotel, tear it down, build some homes. I'm over here shaking in my boots going, whoa, that's big. So, it's good talking to guys like you, because we all can think bigger.
Well, the cool thing was, so I didn't go to college. I had no money. I had no financial backing. I mean, I learned it all the hard way from the ground up.
Yep.
Like I said, my first lesson cost me $200,000.
Yeah.
Now I did self-educate. I had books, courses, things like that, industry professional education, as well as personal professional development. And then I spent time around people that were more successful than me. And every conversation started out, hey, I'm Greg, I'm young, I'm a seeker of wisdom. I've got this opportunity here. I don't know what to do with it. What do you think?
Yeah.
And, I'd sit down and ask them, what would you do if you were me in this environment? And they're like, man, you could do this, you could do that, you could do this. So that's what I did. I just did what they told me to do. And I went out and started, getting land under contract, tearing down hotels, redeveloping. The cool thing about that was those houses are like little apartment buildings. So, these houses I were building, they were 12, 14, 16 bedroom houses, 8 bedroom houses. Jeez. And they were doing, they're resort rental houses. So they're doing anywhere from, 160 to 200 some $1,000 a year in income. So they're like little apartment buildings.
Yeah.
So they totally paid for themselves, and, you build them, put them in the rental program, income's coming in until they sell. Yeah. Usually they sold a year later for more than what what they were worth when you built them. So it was a pretty straightforward, safe vehicle until 2009.
Yeah.
And, then I started building houses that, cost less than the kitchens in the other houses. Right? A little affordable,
a little different
for people. Yeah. But it still worked. I did, I don't know, 15 or 20 of them a year. And, they were land and house. They were probably costing me $200,000 to $300,000. And I was selling them from, $300,000 to $400,000. And people were buying them as second homes and, vacation homes, year-round homes. And, VRBO and Airbnb was just starting to take off back then. Yeah. So I still build those today. I still do, I don't know, 8, 10, 12 of them a year, whatever I can do.
Very, very cool. So one place I'm going to take a sharp right turn for you because of your wealth and wisdom and experience is, I fear, and especially in the multifamily space, right? We just talked about how multifamily, everybody's lending. It's a good time to be. But sometime in the near future, I'm guessing 3 to 5 years, cap rates are going to go from, I don't know, 4.5, whatever they are in your area. They're going to go up a couple of points, which is going to take values down, as you know. What I'm concerned about is when that happens, all of these commercial loans, which have 5, 7, or 10-year periods on them, have to be refied.
Yeah.
Isn't that going to crush the equity position? I mean, am I playing this wrong in my head, or is that possible?
So here's the thing about all that. So number one, as far as the cap rates go, the first thing you want to look at from a sponsor or deal is your reversion cap rate. So your exit cap rate should always be higher than your going in cap rate. So when you buy a deal, you're already baking in the fact that you're not going to have the same cap rate today that you're going to have 2, 3, 4 years from now. You're banking on it going up.
Okay.
So your entire business plan needs to be written on the fact that the property's going to be worth less from a cap rate standpoint, but your income hopefully should grow, but it needs to grow reasonably and responsibly. And especially in relation to the laws in your state, you really got to watch rent control. I mean, it's becoming a movement nationwide.
Yes.
So for anybody listening out there, make sure you understand what's in process in your state, your locality. I mean, it can be at the local municipal level, it can be at the state level, and it's becoming a federal issue. Rent controls, things like that. So understand what that means in your area, what your limitations are, what your maximums are, and learn how to play the game, because that can be a good thing too. So you want to learn how to play the game. So when you underwrite and you buy, you need to make sure that you're factoring those things in. So if you do that, if that scenario you're talking about happens, then you're going to be okay. So in the back end, when you go to refinance, then you're going to have a couple of things. If the property does not value out where it needs to, you're either not going to be able to pull the investment out. So you have investors you have to deal with. And you have to have that conversation and say, look, it's in your PPM. All of this is in your PPM. Hey, we may not be able to get your money back. You may not make any money. You might lose all your money. When we refinance, we may need to redo this whole thing. So you'll have to have that conversation if it doesn't work. Then you also have a conversation with your lender. The last thing Freddie and Fannie want is that loan back. Right? They don't want it. So they will work it out with you, but they're going to want something in exchange generally. For sure. Maybe a little bit more cash, maybe a higher interest rate, so whatever that is. So for the most part, as long as you've done what you said you're going to do, as long as you haven't fleeced the property, as long as it's been maintained, the cash flow is still there, and you've done a good job at managing, they're going to work with you. They're going to work that out. They do not want a flood of REOs in the multifamily sector because they're pushing so much money out right now. They know. Everybody who's there now, they were there in 2009. The big people,
no question.
They know what the potential is and what could happen. And a lot of deals are very thin right now. A lot of people are concerned they can't find deals, but it's yield. So if you can borrow money at sub 4%, you're paying a 4.5 to 5 cap, and you put enough equity in it, it's going to pay for itself.
For sure.
Hopefully you can grow rents a little bit, but again, you got to be very careful what you're projecting that rent growth to be, and understand if the government, state, federal, local is going to allow you to even get there. So as long as you got those things in there and you understand what the lenders are after at the end of the day, which is they want yield on that loan. They don't want to take it back. They don't want it not servicing. They want yield. So you're going to be able to, manage that situation in a workout when the time comes, as long as you've done the right thing.
Well, it just goes back to, I remember extend and pretend being a big thing. Back in like 2010, 2011. It's like, no, we don't want it back. We'll just pretend just keep paying, right? Now, we're fine.
So here's another strategy. So there are a lot of bad actors out there. There are a lot of bad characters doing, fee deals and just totally not doing the right thing.
Absolutely.
And I'm not going to say who, I know who. I'm not going to say who, but there's a lot of that going on. So that will create opportunities for Michael Zuber and for Greg Dickerson to step in and take those loans over, no money.
Absolutely. So, they did it last time.
Yep. So a lot of people don't realize that. And they think that's just, whatever. I'm telling you, the banks would rather have a serious operator with a balance sheet and with experience come in and just take that thing over for nothing than take it back or have to work out some long, situation with somebody else. And whoever's on the other end of that, same thing. Now, again, the whole issue there is going to be the investors, so whoever their LP investors are, how that situation gets handled. Because in essence, if a property is in distress and it's an REO situation, they're all wiped out.
They're wiped out. They're gone. Yeah.
Right. So the prudent thing to do, the right thing to do, is to step in with the investors and with the sponsor, and you work a deal with them and say, look, sponsor, you're out.
Yep,
You've
gone.
had your share. Investors, we got a new deal moving forward. And then you rewrite the whole deal with them, keep them in the deal. So hopefully they can get something back down the road.
Yeah.
Or you can wipe them out. I mean, that's up to you.
Yeah. And again, this is something I saw last time. I mean, everybody talks about buying homes cheap during the REO craze when people were losing them, which we did, right? Michael Zuber did, right? But I took over almost 50 units, as you said, zero down, right? Banks came knocking on my door going, hey, you're remodeling X. Do you want mine? Literally, do you want mine? I'm like,
yeah.
Right. So that's what I expect to be happening. I'm on record saying I'm raising cash now because I expect the bad actors to be punished in I'm guessing 2023, but we'll see. So I fully expect that, opportunities to come up to take over full on multifamily apartments with zero down again. And I'm going to be ready for it. So that's what I think's happening.
Yeah, it's coming around. We'll see it here in the next 2 or 3 years. And
exactly.
Yeah. And
all
it's, it'd be a great thing. So keep those relationships going with the brokers and the lenders. Stay in front of them. Let them know that you're ready.
I'm ready. I got the balance sheet. Let's talk. So any closing thoughts on this episode, Greg? This has been a lot of fun.
Yeah, it has. So the moral of this story is, we're not like, trying to, make anybody afraid or worried or scared. The thing is, just understand the rules and the laws in your state and at the federal level, all the way around, and, make sure you know what you're offering your investors and that you know what the requirements of that is. That's all, and then that way, if something goes wrong beyond your control, like an insurance company would think about the worst case scenario of everything. The worst case is you're out of this world and your estate and your family is left dealing with everything, or your investor, partner, so you want to make sure that you've got a stopgap in place for all of that to, be taken care of in the event of the worst case scenario. And if everything is done right, your I's are dotted, your T's are crossed, you've got all the right paperwork in place, you won't have to worry about any of those issues affecting your estate, your investors' estates. Everybody's clean. The more you have in writing, the more you anticipate the worst case up front, the better the outcome is at the end.
Very, very cool. Well, Greg, thank you very much for getting to Panera Bread early so we can have this conversation. I appreciate it. We will talk next week.
Yep. Sounds good.
All right, buddy. Take care.
Thanks, Michael.